Capital allowances, what are they and how can that help you to save tax as a property investor? Well, that's a great question, and it's something that Louise and I will discuss with Jake Ills in this video. Let me just go on to this. So,
we've got a new piece of technology, Jake.
Zip it. This is my show. Right. So, Mr. Google has asked, what are capital allowances? Jake.
Oh, right. Okay. From the top, then, I suppose capital allowances are sort of given for any capital expenditure you make as a company or as an individual. So, I heard you just talking about buying cars and buying equipment, but also when you buy commercial property. So the allowance itself is a tax incentive for the investment to reduce any profits, taxable profits you make, whether you run your company or your partnership as a trade, a property business, or you have a finished holiday let business. And the reason why I explain about those three things, maybe we might have a few questions about that a bit later. So if you're buying, building, refurbing or fitting out any commercial property, then the incentive's there for you to reduce your taxable profits as you become profitable, or if indeed you're already profitable because you already run a business with property in them. So the main points are for capital allowances are you have to own a company. The asset must be owned by the company or by the individual. You must be carrying out a trade, and the expenditure must qualify. You can't hold the asset in a pension, can't be part of a charity, can't be held in a public body. And interestingly, maybe for some of the developers out there, you can't have it for developers generally because they hold their properties as trade in stock. But there are some nuances around capital allowances that could be very, very useful, particularly around sort of types of land relief. The allowances are not given automatically, so you must claim them in your tax return, either your CT 600 as a company or your SA 100 as an individual. There's no time limit generally, as long as the asset is still owned and is still being used in your trade.
Perfect answer.
So the way I sometimes describe it for simplicity, I guess, Jake, to our clients, is that it's an extra, think of it almost like an extra receipted expense that you can access to help minimise your tax. And I know that's a very oversimplified perspective. No. Is that a fair comment to make for someone first trying to get their head around capital allowances?
Yeah, I think it's a useful cash flow consideration. So when you make a big investment, then you're not always going to be profitable. So it'd be nice to see a return on that investment. So maybe you could use the allowances and the benefits as a means of running a loss, and or there's no taxes to pay going forward, or you just cash flow your mortgage transactions, for example. Might be a nice way of paying your mortgage transactions in a simple way. So.
Okay, lovely. Thank you.
Perfect start to the show. So moving on to the next one.